Hello and welcome to the DIY Investing YouTube channel. Today we are covering every company in the S&P 500, and today is CenterPoint Energy, ticker CNP. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, we see that the market cap is $18.5 billion and the EV is $29.7 billion. That means you have about $11 billion in additional leverage on this business. It's highly indebted. Now, it is a multi-utility company, which probably means it's operating in multiple different groups, which it is, through electric and natural gas segments. It operates in the United States, utility holding company. It has natural gas distribution, and it has electric transmission and distribution services to electric customers and assets in the wholesale power market. So, headquartered in Houston, Texas. That tells us a little bit. Utility companies tend to be both lower volatility, but also relatively low return, and we'll see if that holds true as we dive deeper in. Now, return on invested capital. Immediately when I see this, I'm not super interested with what I see here. It looks to be relatively cyclical. You have quite a few years of losses as well. So you lost money in 2002, 2004, 2015, and 2020. So that's 4 years of losses out of 20, which is a bit high for me. I'd like to see 20 straight years of profits, but barring that, 19 out of 20 years with profits is my threshold for a high quality company. So far it's on the lower quality side. The next thing we see is that all of these numbers of when they do make profits are relatively low on the return on invested capital. So you have 3.8%, 2.4, 4.1, 3.5, 2, 3. You get up to 10% in 2011, but it seems to be a fluke because you immediately drop back down to 3%. You have a high of 4% in 2014 before they lose money. You get to a high of 14% in 2017, but you basically only have 2 years out of the entire 2 decades, maybe once a decade, where you have double-digit returns on invested capital. And if you're not getting double-digit returns on invested capital, then you're highly unlikely to get double-digit returns as an equity investor over time, simply because you're going to be struggling against that very capital-intensive business. So all this right here is telling me it's a low-quality business. This is reinforced by the 10-year median returns of assets at 2%, return on equity of return on capital of 3%, and return on equity of 9.7%. Anytime the return on equity is below 10%, I immediately become very uninterested because this means that it's going to be hard for me to get a 10 to 15% return on my investment because the equity isn't even earning that if I buy it at book value. But this company is trading above book value. It's at 1.9 times book and PE is 11. So you're not even getting the return that you say here. You're going to be getting a much lower return than that. Now, what else can we see? We can see that revenue has basically not grown across the decade. You're at 0.1% negative revenue growth, which is basically flat, but your assets have grown at 5.7%. The fact that assets are growing and revenue is not is what's driving this drop in earnings per share. It's what's driving these low capital returns. You're very capital intensive. You're having to put capital back into the business, but you're not getting capital out. You're unable to grow. And this is just a general problem for regulated utility companies. I believe part of this is operating in an unregulated market. I know the Texas market's unregulated for electric distribution at least, but they might be for gas. Either way, you can see just the massive problems this is going to cause over time. You're going to get worse and worse returns. You're unable to return capital to shareholders because you're having to reinvest it in the business, and you're not earning high enough returns to have both that funding and otherwise. What we're probably going to see here as we dive deeper into the balance sheet and the income statement is they're raising debt, they're probably issuing shares, and even if they are paying dividends, it's probably more of like a Ponzi type structure where they're paying out dividends, but they're having to raise equity at the same time. So we'll see how that works out. But overall, even at a PE of 11, this company is going to be pretty overvalued. You're going to want to get it at a much lower than 1 price to book in order to justify this setup. If you're enjoying this video so far, please hit that like button and don't forget to subscribe. And if you ring the bell, you'll get notifications as I upload new videos each and every week as I work through the S&P 500 and all the other companies and stocks that I look at. So income statement. Now, first thing is we see positive gross profit every period for a decade, that's good. Positive operating profit every period for a decade, that's good. But you do have a loss here in 2020. And part of that loss appears to be driven, it's very unclear because you have basically pre-tax income, and you say you have some negative operating tax and negative net income here. So something is really weird here. I don't know if these numbers all add up. So there's something I'm missing, but you see a huge percentage of interest you're paying. $500 million in interest is a significant amount here. And we can clearly see what I was saying was true. So you start the decade with 420 million shares outstanding, and you end the decade with 593 million shares outstanding. You're basically up somewhere in the range of 40% additional shares, and yet your gross profit has hardly increased. Your net income, your pre-tax income's hardly increased when you go across this decade. And so this is what's happening, is your EPS is getting worse and worse and worse over time because you're issuing new shares, but you're not growing. Likewise, when we go to the balance sheet, you can pretty quickly see that they've had to grow their PP&E from $12.4 billion to $23.4 billion, and I would assume they're also growing their debt. So we started the decade with $8.6 billion in debt. We end the decade with $15.5 billion in debt. All of this is happening with low interest rates. They're able to pull this off with low interest rates, and they're still not growing. This company is going to have horrible future performance because you have this massive debt load. You're having to continuously grow assets, and for whatever reason, you're unable to grow your income. And if you can't grow your income, then that's going to destroy your shareholder returns. Let's see, do they have dividends? Are they paying dividends? Cash paid for dividends. They're paying out an absolutely massive dividend when you consider the fact that they have no free cash flow, basically. You see cash from operations, $1,860, cash from investing, $1,600, $1,300. You're basically having to reinvest your entire cash flow from operations, and yet you have nothing left over for dividends. And so the only way they can pay this dividend is to continually issue out debt. And so you're issuing debt, you're issuing stock, you're doing all this in order to just stay alive in terms of the cash flow. And so you can't afford to pay the dividend that you're receiving. So even though you're receiving a dividend, it's really just unable to be relied on because you have that false sense of precision there. So I would avoid this company, would not go on my watch list. It's relatively low quality. You have these low return on invested capital. You have no growth to speak of. You have a pretty high valuation for something with no growth, low returns. You're paying substantially above book for a company that doesn't even deserve book. And so for me, I avoid CenterPoint Energy. If you enjoyed this video, please hit the like button. I do have videos that show stocks that I enjoy, so please subscribe and you'll get to see those videos as I work through every company in S&P 500. Thank you for listening, and until next time, stop paying fees, start building wealth.